News Talk 94.5 WPTI, 96.7 FM WTOB, and you're listening to the Wealth Guardians radio show. I'm Doug Ray, helping you to retire that job but keep your paycheck. And, of course, with me today is Mr. Brice Payne. Hey, Brice.
Good morning, Doug. How we doing? How we feeling?
Good. I'm good. It's Q4 now.
Q4. That's right. It is.
Yeah.
Well, glad to see you in here in the studio again, get a good radio show out of the way. You know what time it is. It's time for the time of the month for the listener questions. So we're going to be dipping into our listener question mailbag as we try to do at the first of every month. So
yeah, we've got a few good ones in here.
It is the first of my favorite month, my birthday months.
Oh, yeah.
And it's, also because of football and the colors and all that. Favorite time of year coming up right now. So happy for all of that. Doug, let's go ahead and do our Wealth Guardian Service salute as we want to take a minute at the start of every show, every weekend, and just give our thanks and acknowledgement to the men and women that put on the service uniform out there, our first responders, their families, everybody who goes into that oftentimes thankless job for the better of all of the United States. And we just want to say thank you. We know it's an underappreciated job. It's a lot of hard work. And, we just want to take a minute and say thank you to everybody out there. Doug, you served in the Navy, as did Garrett. So thank you guys for your service. But anybody else out there listening who puts on one of those uniforms, we want to thank you as well. Thank you for what you do. And we also do at the start of every show, Doug, as you know at this point, been doing this for a little over a year, almost 2 years now, taking a minute and giving everybody out there an opportunity to better get to know their Wealth Guardians advisor. And so what do? We ask ourselves a question that everybody might be able to relate to and see what our answers are. So the question we're going to ask ourselves this week is, Doug, what was your favorite TV show growing up?
Here's where I get to show my age.
Okay.
Look, there's no way I could give you one.
Yeah, we go through different stages of life.
Yeah, I mean, I loved Andy Griffith. I loved Beverly Hillbillies, Dick Van Dyke, I Dream of Jeannie. I mean, Red Skelton. There were some great shows back in the day. And, I watched all of them and loved them, watched the reruns. I Love Lucy. That was a great show.
That was a good one as well.
Yeah. So, all of those shows. And in fact, sometimes I still watch some of the reruns.
Were there any shows you weren't allowed to watch?
No, I mean, TV wasn't that racy back then.
Yeah, I wasn't allowed to watch I Dream of Jeannie. My mom didn't like the concept of a man keeping a woman imprisoned in a bottle wearing scantily clad outfits. So I wasn't allowed to watch that. But
she got out of that bottle quite a bit.
She did. But I had a sophisticated taste. My favorite show growing up was the McNeil-Lehrer Report. And that's not true. My growing up when I was younger, it was Gilligan's Island.
Oh, that was a great show too.
And then later on, Dukes of Hazzard.
I like that show too.
Dukes of Hazzard. All right. Well, there you go. Now everybody out there has a little bit better sense of what Doug and I would turn our brains off to when sitting down in front of the old boob tube, as I think as they used to call it. That's just who we were, and maybe we watch something a little bit different today. I know we're all into anything that has a ball being thrown in it or kicked around. We enjoy those shows now. Well, let's go ahead and get to this, Doug. Our listener questions, like I said at the start of every month, we want to dip into that listener mailbag, and we do have some good questions. We always have good questions, but there's some good questions here. And it just gives everybody an idea to get a sense of what types of questions is it we help people with. So here's a good overview of them. So the first question comes to us from Abby, and she says, Doug, and Brice, and Garrett, what is the wildest financial decision a client has ever made? I feel like I'm a pretty boring investor and plan to stay that way, but would love to hear some of the more creative decisions and risks people have made. And Doug, I've been in this field about 15 years. You've been doing it for 35 years now? 37?
Couple more than
30, okay.
37.
So you've seen obviously more out there than I have, but to give us an idea of something that sticks in the back of your mind is, wow, that was a creative investment. Whether well-advised or ill-advised, could be either way.
I've seen a lot of things. I think the one thing that comes to mind happened relatively early on in my career. One of my neighbors was a client at the time, and this is decades ago. This maybe was 30 years ago. He owned a tract of land outside of Charlotte in a little community called Weddington. which back in those days was just an old farm community, and that's had a bunch of land, it was all farms, and his was a family farm. Well, Weddington started to grow. He got this idea in his mind that he was going to build a neighborhood, a subdivision on his family farm.
Okay.
And he wanted to do it by emptying his IRA, $250,000, to put in the infrastructure.
Okay.
And I did my best to try to talk him out of it. The taxes, the early distribution penalty, your chances are this opportunity may not turn out to be what you think it's going to be.
So he was under 59 and a half. Mm-hmm. So, okay. So that's when you can take funds out of your IRA legitimately without a penalty. So he was younger than that.
Yeah. Well, thankfully I was wrong. He did take the money out of the IRA, put in the infrastructure, started building the neighborhood. Weddington took off like crazy.
Right.
Today, you can hardly find an acre of land in Weddington for less than $200,000.
Yeah, it's a lot of high-end homes down there.
Yeah, it's tons. So it worked out beautifully for him, but it was kind of, at the time, a wild and crazy idea. And $250,000 in an IRA back in those days was a lot of money.
Now, was that a vast majority of what he had?
Pretty much.
So he was overweighting himself in one particular field or sector as well.
He was land rich for sure.
Okay. Interesting. All right. Well, the one that comes to mind for me was, this was an appointment you and I were both in. This was only, I think about 5 years ago. And the gentleman, a couple came in to sit down with us to see if they felt like we were the right financial planners for them. And they each had roughly, at one point, $1 million each. The husband did that and she did. You know what I'm talking about here. Mm-hmm. And she had done very well with her investments, but he had decided at some point before coming to us that he would invest 100% of his retirement accounts into silver mines.
Yes.
And went down 75% from when he had purchased them. And so he was now, that $1 million had grown to $250,000. And so he was not in a position where he could basically realize those losses at the particular time, and he had to hold on to those for a bit longer to see some of those gains come back. And
well, if he's kept it, hopefully he's recouped most of his loss now because gold and silver is doing exceptionally well. The miners are a little bit lagging, the price of the metal, but I think they probably have a decent opportunity to move higher.
I think the lesson in both of those, even though your example worked well for him, it would have been a cautionary tale because both of these cases, they were overweighted in what they had done. They basically put everything that they had into one particular investment. And that's not a good idea in almost any case because you want to be diversified to some degree because something can always happen. All the reports could be that, yes, silver mines are going to go up or property in this area is going to go up. This is a good investment. But those reports are not right 100% of the time. So you want to be cautious about what percentage of my investments do I have in this particular sector or field or whatnot. And glad your case worked out. And hopefully for this gentleman we're talking about that he had recouped his losses there by now. If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. And in the studio this morning is Doug Ray and myself, Brice Payne. Thank you for joining us. We're dipping into the listener mailbag that we do once a month here at the start of every month. And that was a question from Abby. We're going to jump into the second question now. And this is from Scott. And Scott says, Wealth Guardians, I want to quit my corporate job and start my own business, which would entail some startup costs. Sounds kind of like what you were just talking about, Doug. Mm-hmm. Should I take the money from IRAs or get a business loan to fund this? What a great segue from the last story that you were just talking about. All right, so what are your thoughts on that?
Well, again, I'm going to advise caution. I'm not sure I would do that. I hope and pray that you become the next Jeff Bezos, but let's face it, the odds of startup businesses are not good, right? You've got a very high chance of failure there. So if you take your money out of your IRA, you're dooming your retirement. A business loan may be the better alternative in my opinion.
Comes down to the interest rate.
Yeah, before you go to that, take that advice and go to the loan situation, you might want to think about taking that IRA money and see if you can, before you quit your corporate job, rolling it back into the 401k because...
Oh, good point. Good point.
Because a 401k is exempt from obligations of creditors, creditor exempt, whereas an IRA is not.
Right. That's a good key difference between the two.
Yeah.
Yeah. And, Scott doesn't tell us what type of business it is. He doesn't tell us how much research he's done into the kinds of risks or whatnot. We don't know. Scott, you didn't tell us what kind of percentage of your IRA you would be taking a dip into. Is that 100% of it? Is it only 50% of it? What kind of experience do you have in this field? Are you pretty confident that, is this something that you've been doing for the last 30 years of your life yourself and you just want to stop working for the man and do it yourself? Or is this a new venture for you altogether that you don't have experience in this field? So those are types of questions. And as we said, what is the loan rate on getting a business loan? Is it 3 or 4% these days? The Fed just lowered interest rates and probably going to see them lowered again. Or is it closer to a 6, 7, 8%? That'll play into the decision making. But unfortunately, we just don't have enough information here, Scott, about you, about your position, your situation, to be able to tell you definitively you don't want to take a loan or you do want to take a loan. And there might be some other ways that maybe you do a mix of both of those things as well. But it's a good question, and I certainly wish you the best in getting your new career going there. But if you'd like to sit down with the Wealth Guardians, it is questions like that we help people kind of weed through and make sure that they are doing the most sensible thing for their retirement. And we'd love to sit down with you as well. If you'd like to sit down with us, we do not charge. There's no cost or obligation to sit down with the Wealth Guardians. And our phone number is 336-391-3409. You could also visit us at thewealthguardians.com and schedule an appointment with us and see if our expertise and our services would fit in line with what you are looking for to better prepare for your retirement. Well, we've got to take a break here. We've got some more listener questions on the other side of the break. But of course, what do we do every time before we go to the break? We leave Garrett, myself, or Doug hemming and hawing at a trivia question. So I've come up with a trivia question here. And Doug, are you ready for it? You never are.
Hem and haw.
Okay. So here's our trivia question. Doug, on October 5th, 1962, the first James Bond movie was released. Sean Connery played Agent 007 in 6 films before being replaced by George Lazenby. What was the name of this first James Bond film? Mm-hmm. All right. Well, stick around for the answer to that trivia question and see if we stump Doug on the other side of this short break. This is Brice Payne. With me is Doug Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI, 96.7 FM WTOB. Welcome back to the Wealth Guardian Show, where we continue to help you retire the job and keep the paycheck. I'm Brice Payne in the Wealth Guardian studio this morning, along with Doug Ray. And in this second segment, we're going to continue taking listener questions over the last month. People write into us and give us their ponderances on what they should be doing differently for their retirement. And we'll see if we can help answer their questions and get them better prepared for retirement. Now, before we answer this trivia question that we left you hanging with, and we left Doug hanging with at the end of that first segment, let me ask you this. Are you planning to retire? Probably the answer there is yes. Have you met with a retirement income certified professional who is also a fiduciary? If the answer to that is not yes, then here it is. Officially, I'm going to invite you to take us up on a complimentary review of your current situation. As certified retirement planning specialists, we'll put together a customized written plan with strategies for portfolio allocation, income distribution, Social Security filing, and tax efficiency, with the additional benefit of often reducing both the risk and fees of your current plan. So if you've put aside at least $400,000 and you want to take us up on this no-cost, no-obligation review, here's how you reach out to us. Our phone number is 336-391-3409. That's 336-391-3409. We've also got one of those websites, and it's thewealthguardians.com. Go to that site if you want to learn more about us. Let us show you in black and white how to retire the job and keep the paycheck. That's thewealthguardians.com. All right, let's go ahead and go back to this trivia question, Doug. On October 5th, 1962, the first James Bond movie was released. Sean Connery played the agent 007 in 6 films before being replaced by George Lazenby. And some people out there saying, no, I thought he was replaced by that other guy. George Lazenby played in 1 James Bond movie in Her Majesty's Secret Service, and he was short-lived. So then it went to, who was the second guy? I can't think of his name off the top of my head. But Sean Connery did 6 films. What was the name of this first James Bond film?
You know, I liked all of the James shows. Sean Connery was my favorite Bond, no doubt. And I got so many titles that are running around in my mind. But so I'm going to guess, is it Goldfinger?
Well, that was one of Sean Connery's 6 movies. It was actually Dr. No.
Dr. No.
Dr. No was the first one. Here's an interesting little side fact about that. Dr. No was actually the 6th book written by Ian Fleming. The first book that he wrote was Casino Royale, which was not made into a James Bond film until all the way into 2006. It was Daniel Craig's first James Bond movie. So that was the first one that he ever wrote. But it was even the 6th book that was written. So I thought that was a little interesting side note there. But yeah, Dr. No, Goldfinger from Russia with Love, in Her Majesty's Secret Service. I got some other ones. Goldfinger, Live and Let Die. A lot of good ones out there. All right, well, let's go back to these listener questions here. And our next one comes from Russell. And Russell says, Doug, Brice, and Garrett, I've been able to live quite comfortably on just my Social Security and pension since retiring last year. However, it just occurred to me that my pension will not adjust each year for inflation. Russell, for some reason, I hadn't thought of that before. What should I do with the money in my IRA that I don't need right now, but possibly will need in future years when everything costs more, but my pension hasn't changed? Yes, Russell, that is almost a universal fact with private pensions. Now, if you have a state or a federal pension, usually there are cost of living adjustments tied into those. But a private pension, Doug, I'm not sure that I've ever seen a private pension that has COLAs attached to it for inflation.
I don't remember one either.
Yeah, so that's pretty standard, Russell. Sorry that it took you till now to figure that out. We do go over facts like that with people who come in and sit down with the Wealth Guardians. In fact, Doug, that is a main question that somebody who does have a pension, their option often is, I've got a lump sum option, or I can take income for the rest of my life, and they can adjust that amount of income if they want it to pay out to their spouse if they should predecease them and their spouse continues to live. You can get a lower amount, but it goes out for the life of 2 beneficiaries instead of just 1. And a lot of times, Doug, people think, well, I'm going to go ahead and take the income. But when we weigh in, well, what is that lump sum amount? Let's figure out what kind of percentage this is that they're paying you. Is it 4%? Is it 8%? Somewhere in between there. And we want to analyze that. And one of the things that we consider is this a private pension that does not have a COLA attached to it? And what are your thoughts on that?
Honestly, this is a pretty easy question.
Okay.
You know, if you've got that situation where your pension does not adjust for inflation, then obviously you've got your fallback is your IRA. Mm-hmm. That has to be invested in inflation-fighting investments. Mm-hmm. So what am I talking about? Stocks. Charles Payne says the stock market's the greatest wealth-creating machine ever devised by man, or something like that. And I agree with him. But also a very well allocated portfolio of stocks and maybe some bonds, convertible bonds, things like that. And don't forget precious metals. Mm-hmm. You know, put some gold in there. That's an inflation fighter. Maybe even some Bitcoin or something like that. But yeah, you've got to turn that IRA into something that's going to offset inflation for you, because you're right, that pension's not going to do it.
Yeah, I would think, Russell, I would like to know some timelines here. Have you done some calculations to figure out how long it is until that pension, without adjusting for inflation, won't be enough for you? The average inflation rate is 3.27 over the last 100 years. We'd probably want to use that in our math equations to figure out how long until Russell needs to start dipping into that IRA. That's going to play a factor. And we would also want to consider how much of your IRA, percentage-wise or dollar amount, are you going to be needing to dip into in the early years versus 10 years later than that. And that, as Doug said, that would start to give us an idea of how much risk you can take in that portfolio, how aggressive we can be with it, how aggressive can we be, how aggressive do we have to be with it to try to get some income out of that. But I think that's probably just, we're touching the tip of the iceberg there, Russell. We would also want to know what your expenses look like. Are there additional expenses that you're going to be incurring down the road, healthcare expenses, something like that? Not sure how old you are, how long you've been retired, versus what your health expectancy is, your life expectancy is, and considering your spouse as well. So there's a lot of things to factor in there. But as Doug said, since you've got one investment, your pension, that is not keeping up with inflation, then we'd want to make sure that the other investments are increasing with inflation. So there's some options there, but diversity is in that portfolio is one of the things that we want to consider. If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. In the studio this morning is Doug Ray and myself, Brice Payne, and we're dipping into that listener mailbag as we do once a month here. I think we've got time for one more, Doug.
Okay.
And this is coming from Jeff. And Jeff says, Doug and Garrett and Brice, I'll be turning 73 at the beginning of next year, and I am annoyed that I have to start taking money out of my IRA because I won't even need it. I'm sure you have some tips for circumventing this rule, question mark. Well, yes, thank you for that question, Jeff. And there are some strategies, strategies that can lower your RMD requirements. Yes, there's pros and trade-offs to some of these tips, but Doug, he's not the first person that has expressed some grievances about having to take money out of his IRA when he doesn't need to.
We hear it all the time.
Yeah.
The fact of the matter is you're going to have to when you hit 73. You got to take that money out. Either that or you're going to lose more of it to the IRS. So which would you rather do? Yeah,
the penalties are insane on not taking out the proper RMDs.
Yeah, I think
doesn't make sense in any world. So you do want to take those RMDs out.
Absolutely.
When you have to.
You didn't tell us if you are charitably inclined. One way to do this is to do a qualified charitable donation. Simply take that RMD and send it directly to your charity or charities. Satisfies your RMD, satisfies your charitable inclinations. So it's a win-win for everybody.
And it's not a taxable event.
Yeah, does it hit your 1040? So it's a good deal.
You have to do that the right way.
Yeah.
You cannot, a lot of people think, oh, okay, I'll get a distribution from my IRA and then write a check to my charity. It does not work like that because the money passed through your own checking account. It was suddenly a taxable event. What Doug is talking about is, and this is only available to people who are 70 and a half or older, is that the distribution check from your IRA has to be written directly to your charity. That will keep it from being a taxable event. It never touched your hands. So that's what Doug is talking about. But Doug, as I am prone to say, the term IRA stands for, the acronym IRA stands for Individual Retirement Arrangement. A lot of people think it stands for account, but either way.
It's arrangement.
It's arrangement, and that's one of the biggest misnomers out there. The IRAs, which stands for individual, the I, it is not an individual account. You own that money with Uncle Sam. Mm-hmm. How much of it he owns is questionable about, depending on what your taxable income is the year that you take the distribution. It's anywhere from 10 to 20%, somewhere in that neighborhood. But people look at $1 million in their IRA, Doug, and they think, I own $1 million. And that's not the case. You have to constantly do the math and say, I don't own all of that $1 million that I see there on my statement. Uncle Sam owns a portion of that.
Yep.
And if it's around 20%, that means you own $800,000. And Uncle Sam does require you to take that out at age 73. It'll change to 75 in a few years, but for now it's 73. And if you don't want to take that money out, you could look at IRA to Roth conversions. That's a tool. There's a lot of math calculations that go into that. It does not work for everybody. You certainly don't want to convert over 100% of your IRA. It is a taxable event in the year or years that you do those conversions. But if you believe that taxes are going to go up in the future, mathematically, it makes sense almost 100% of the time to do it to some degree or another. Like I said, a lot of math calculations that go in that, Doug, and you'd have to sit down with a holistic financial planner that knows how to run that math and give you advice on how much conversions to do and over what years and how much each year.
Exactly.
Yep. All right. Well, Jeff, thank you for that question, and thank everybody else for writing in. Sorry we didn't get to all the questions that we wanted to, but we will be back here again in a month with more listener questions. Unfortunately, that is all the time that we have this week. I want to thank you for joining us. And this is Brice Payne. With me is Doug Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And I want to remind you, sound financial plans do not create themselves. This is News Talk 94.5, WPTI. This is 96.7 FM, WTOB.
Hi, it's Garrett Ray with The Wealth Guardians. Thanks so much for listening to the show. Make sure to check out our weekly series, The Vault, on YouTube. Find our channel, The Wealth Guardians, where we talk about all things retirement planning and cover new topics each week, such as Social Security, tax planning in retirement, and our thoughts on investment best practices, and much more. New episodes air Thursdays at 2 p.m. Make sure to subscribe to the channel so you can get notifications when we release new episodes. We're here to help you retire the job and keep that paycheck. We'll talk soon.